Hello and welcome, everyone. Thank you for joining us today at Kerr Financial's webinar. I'm Kathleen, and I'll be your host and facilitator for the session. Our topic today is timely. We'll be looking at what happened in Q2 and how markets responded to renewed volatility and what smart investors are doing now to position their portfolios for the second half of 2025. We're also going to take a closer look at trends we're watching across geographies, asset classes, and alternative investments, and how we're working with our managers to adapt to these challenging conditions. So let's start with the agenda. Chris is going to walk us through the Q2 market review, touching on what's driving recent volatility, what shifted in April, and how investor sentiment and central bank actions are influencing the outlook. Then Frank's going to take a deep dive into our perspective on portfolio strategy with a focus on alternative investments, including how they fit into today's environment of rising volatility and lower bond returns. Finally, we're going to wrap up with a Q&A. And just a quick reminder, you'll note that at the bottom of your screens that there is a Q&A icon in the toolbar. Please click on this icon to type in any of your questions that may come up. We're going to organize and keep them all together and address them with our panelists at the end of the webinar. So stay tuned for that. Just a quick piece before we get into the market review to highlight some of Kerr's investment philosophy. This is the lens we use when we're evaluating markets and building portfolios. As a discretionary manager, we act as a fiduciary, which means we're required to act in the best interest of our clients. And our approach is built on a few core principles, which is a discipline focused on long-term objectives, deep diversification across asset classes, regions, and managers. And we use a multi-manager model where we carefully select and oversee best-in-class investment managers with different styles and specialties. And this structure helps us build resilient portfolios and allows us to adapt quickly when the environment changes. Krista will be our first speaker today. She is the CEO of Kerr Financial, and she's responsible for the overall management and leadership of our firm. She's a highly accredited individual with multiple designations, including her CFA. She's on our firm's investment committee. She leads our multifamily office division. And our MFO division provides integrated services to support our high net worth families with multi-generational wealth stewardship. Krista is a thought leader in the Canadian personal finance industry. She's appeared frequently on television, radio, and newspapers addressing various planning and investment topics. Next up is Frank. He's responsible for our Montreal Investment Management Group. He's on the senior management leadership team here at Kerr, and he leads the investment committee. He started his career at a Montreal-based investment management firm and then spent 15 years as an equity analyst helping portfolio managers in security selection as the vice president of Canadian equities. Frank is a CFA and a graduate of the John Molson School of Business. So I'm going to invite Krista to turn on her video and mic, and we'll start with the first polling question.
Hello, everybody. Hope you're doing well. It's a little bit stormy looking around here. I guess we sort of face these ups and downs in the investment world as well as the weather world. But hopefully everybody's having a good summer regardless. As we've done in the past, we want to start with a polling question just to get a sense of what your thoughts are. So our question is, if you think ahead to the next 6 months, what would be your biggest worry? Is it a resurgence of inflation, which some people worry could be a result of tariffs? Is it the ongoing geopolitical strains that we see? Is it a slowdown in the economy, which could at the very far end be a recession, but a slowdown nonetheless? Is it a concern that the markets with high valuations and these risks will experience a crash? Is it the higher debt and deficit levels, certainly highlighted in the US after the most recent bill, but also in many areas of the world? Or is there something else on your mind? So we'll ask for you to take a minute just to see what your biggest worry is, and hopefully we'll be addressing some of those risks as well as how we're managing and mitigating them in portfolios.
Just give it a few more seconds for people to put their answers in. Alrighty, I'm going to end the poll and I'm going to share the results.
Oh, interesting. Yes, so we have two sort of leading potential answers, and I'm going to read them out because when people do a playback of the webinar, they don't see this response. So the highest weight was 48% of participants saying geopolitical conditions remain concerning. 34% are worried about some slowdown in the economy, and then 10% are worried about the markets falling back. Only 3% concerned about inflation and 3% other, which maybe is some combination of everything of the above. We don't know. But we will try to address those as we go through the webinar today. So as has been the sort of practice in our recent webinars, we're going to talk a little bit about what happened in the quarter. So in the period from April to June 30th. Then we'll talk about how markets fared, so you can have that backdrop and understanding of the context for your own portfolios. And then most importantly, what's going to happen from there? Where do we think the outlook goes based on that history, and how are we positioning portfolios? So if we think about this whole first half of the year, and especially true still in the second quarter, we did have markets in flux. It doesn't feel like it exactly because it was a very short-lived down period in the second quarter. But we've had these uncertain trade announcements and other factors that are really leading to some uncertainty in the markets. The beginning of the quarter started with the Liberation Day announcements from the US administration, which were much more aggressive tariff announcements than were originally expected. And that caused a really sharp decline in equity markets. In the US, they actually almost went into correction territory, down about 18%, so just under the 20% that would be a true correction. So that sparked a lot of fear, and that was really fear that these higher than expected tariffs were going to cause a real slowdown in the economy and could push the economy into recession, as well as creating pressure on inflation and prices. And so that could create a stagflationary environment, and that really made everybody nervous for the first week of April. However, fairly quickly, everybody will remember, I'm sure, there was a pause of 90 days announced in the implementation of those tariffs. There were also some ongoing talks that happened, particularly with China. So there was a feeling that there was maybe going to be some movement on those tariffs, and maybe they wouldn't be implemented as aggressively as proposed. That gave people a sigh of relief. And also the economic data was looking pretty good. So all of that led to a very broad-based recovery in equity markets, which you'll see in our following slides in a minute. That recovery in the equity markets offset pretty flat fixed income returns. You'll see that the universe index in Canada was very slightly down on fixed income. If you were more short duration corporates, you were slightly positive. But the equity markets offset that to leave us with a positive balanced portfolio return that we'll see in a minute. The other thing that was really of note in the quarter was the pressure on the US dollar. And I think that's a combination of trade uncertainty as well as the deficit levels and concerns there. Those things combined to bring the US dollar in Canadian dollar terms down by about 4.6% in the quarter, which impacted the returns when we look at them in Canadian dollars. So next slide just looks at the market. It's actually from the beginning of the year to more recently in July. But you can see this is the US equity market just to see. And if you looked at just before that drop in the markets, that's when the beginning of April happened. So on April 2nd, we saw that big drop down with the US tariff announcements. And then as you can see, pretty quickly, we saw things stabilize. Consumers felt that the tariffs wouldn't be implemented as aggressively. And then we saw that quite broad increase in equity markets through to the end of June. So just showing pictorially what we mentioned on the previous page. This looks at our market returns, and this is all in Canadian dollars. So because the US dollar has come down versus the Canadian dollar, the US returns don't look as strong as they look in local currency. But you can see, as we've done before, we've got asset classes across the bottom, and we've got bar charts for both the quarter, the year to date, the 1 year, etc. So the purple bar chart on the far left of each grouping is what happened in the second quarter. In terms of cash, you can see we still had a positive return, 0.6%. So that would annualize to 2.4%. You can see that's not as high as it has been because rates have come down a little bit, but it's still a positive return in cash. On the bond side, there's that small negative, down 0.6% that we saw in the FTSE Universe Bond Index. And again, that's slightly positive if you were looking more short duration corporate. The Canadian equity market was up 8.5% in the quarter, 10.2 for the year, and 26.4 for the for the year to date. The 26.4 is for a 1 year period ending June. So you can see that big recovery from last year. So positive returns in Canada. If you go to the US, which has been different than we've seen in the past, the US was up, but only 5.2% in Canadian dollar terms. It was closer to, almost 10% in local currency. And then for the year to date, the 6 months ending June 30th, the US market was only just above flat, given the challenges there and the currency impact. But again, strong returns, if you go out 3 and 5 years, it's still stronger than the Canadian market. International markets, both the developed markets and the emerging markets were higher than the US, up 6.2% international equity, large cap developed markets, and 13.8 for the year to date. And on the emerging market side, which would include China, there's up 6.4% for the quarter and 9.6% for the year to date. So those things all come together to the far right, where we show a balanced benchmark that's just a combination of those indices, a balanced portfolio would, using those indices makeups, would be up 3.7% in the quarter and 5.2 for the year to date, and up 14.4 for the 1 year. So we had that difficult start to the quarter, but then we had that broad recovery. If we look at the next slides, you'll see where that came from. So as we'd seen last year, the quarter was really dominated by the growth in technology and communication services stocks. So those Mag 7 stocks came back after having had a harder time in the beginning of the year. Industrials and consumer discretionary also positive. Those are the light bars on the left-hand side of each grouping. If you look at the year to date for the 6 months, you can see that on the other side, you had the growth coming from utilities, real estate, healthcare, consumer staples. So a little bit more of the defensive sectors doing well in the first part of the year. It really speaks a little bit to the benefit of diversification. Nice to have those large companies come back in the quarter, but also beneficial to have had the other stocks in the fullness of the year so far. And you'll see the same thing on the next slide, which is looking at factors. One of the things we like to do is make sure your portfolio is balanced, not only in asset classes and geographies, but also by where the returns come from. So in the second quarter, again, the lighter bar charts on the left of each class, you can see the big return from growth stocks again, 17.7% from the growth stocks, which would include those information technology communication services companies, 11.8 from small cap, so that being very strong. The world markets outside of the US again being very strong, so 11.6. Quality still being good, but then lesser returns in that quarter from value, dividend, and minimum volatility. And then if you look at the year to date, that's a little bit flipped, with a little bit more contribution coming from value, dividends, lower volatility stocks over the fullness of the 6 months. So again, I think this speaks to the benefit of having diversification in the portfolio. One of the things that that really supported that recovery in the second quarter was the fact that investor sentiment changed a lot over the period of time. So initially, after those tariff announcements came out, people were quite concerned. Sentiment of investors was down, and that impacted the market activity. That really shifted to people feeling more positively about the markets. So we wanted to sort of unpack a little bit, why are people feeling more positive, and why, and does that even make sense? Is it warranted, the greater positivity or the improved consumer sentiment? So in terms of what was supporting positive outlook, so the fact that the tariff implementation was paused and negotiations were underway was a positive during the quarter, made people feel more comfortable. I think markets are still feeling that's the case, although there's perhaps more risk as to where we're going to end up with those tariffs before August 1st, that we can talk a little bit about in a minute. But that was a positive factor. Also, the fact that economic growth has been holding up. So there's been this concern that with some tariffs being implemented or being announced, that growth would slow, especially after people were buying things early in the year ahead of these announcements. So thinking that would slow things down. But the growth overall held pretty steady and was quite resilient. And there hasn't yet seen that impact that we haven't yet seen that impact that might come from tariffs. Similarly, we haven't yet seen a big inflation shock. Inflation has been hovering around target levels, still being a little bit persistent, but it hasn't been a big shock upwards. Jobs markets have been positive, and corporate earnings reports have been positive, even though there's been some concern expressed about, people being cautious, companies being cautious on their outlook and their spending plans. But those things are all fairly positive. I guess the other things that might come up in a later slide, there's still some stimulus. If you look particularly in Europe, where they've got, they've had faster reducing interest rates, and they've got some announcements of fiscal spending, those have also been positive factors. On the other hand, we don't want to miss some of the factors that remain cautious in the market. So when you look behind the scenes, there are still some economic factors that are showing some strain when you look at the manufacturing indexes, et cetera. And that early buying that was happening, that was supporting things maybe a little bit artificially, has stopped, because we're now in a period where tariffs could apply, and so that benefit is fading a little bit. We still have uncertainty about the trade landscape, and the impact of any trade introduction will likely be delayed. We still have geopolitical risks. We have valuations that have now ramped back up to high levels, especially in the US, and that corporate uncertainty is putting some pauses on capital expenditures and hiring in the corporate sector. You still have that back and forth. There's always news coming out. I mean, yesterday we saw a little bit better retail numbers than we expected, a little bit better jobs numbers in the US. So it's like some of the fundamentals are holding up quite well, and yet there's a little bit of a cloud still out there. So I think, there is some reason for things to have been positive, but we shouldn't forget about those risks. And that's why we want to build in some defensiveness into the portfolios as well. We thought we'd pause on the next slide just briefly on, where are we now? I mean, it sort of, I think, went from from concern to sort of limbo. We don't know exactly where we're going to be in this tariff environment. But the Yale Budget Lab updated their numbers this last week, where they're now saying that U.S. consumers would be facing an overall effective tariff rate of 20.6% if all the announced rates go into effect on August 1, and that would be the highest since 1910. So there's still that potential risk out there. I don't think everyone believes that everything will be implemented exactly as announced, but there have obviously been recent announcements that have been more worrisome. So important to us here in Canada, the announcement of a 35% tariff on Canadian goods that are not covered by the USMCA, which is, I guess, their wording on their side, or CUSMA. So there's still a lot of goods that are exempt. I think it's about 40% of imports that go to the US from Canada are covered by the USMCA, so wouldn't be impacted by that. They also announced a 30% tariff on the EU and Mexico, and these were things that would be in place by August 1 if negotiations didn't proceed in a better light. So there's still some uncertainty about where things are going to be. There's also uncertainty. I think we talked at the last webinar about why the administration is doing this, and we talked about a number of logical or potentially logical reasons they may be looking at that. It's a little bit harder to see that now because sometimes there's announcements of, tariffs, for example, on Brazil that had to do with a political change in their country that has nothing to do with trade. So there is some uncertainty about where we're going to land and about what the negotiations are really trying to target. It sounds like a lot of people are feeling that a floor of this general tariff level might be the 10% level, and perhaps we'd be looking somewhere at 10 to 15 or 10 to 20 or in that 10 to 25% range. So it still remains to be seen where we will land, but there will likely be some tariffs. And I think the market's reaction, which was a little bit muted to these new announcements, was still thinking that there will be some pullback from the announcements and things won't be implemented as they've been announced. But I think we do need to keep an eye on it. I think, the president probably doesn't like people thinking that he is a taco trade, a chicken that's going to always back off. So he may dig his heels in a little bit more. So I think we need to be aware there could be some tariffs, but it would be nice to at least have some clarity so that everybody could plan for it. And hopefully negotiations will be more positive, but remaining uncertainty on this front. The other thing that causes some uncertainty is that the central banks are still in a pretty tough spot. You'll remember we've talked in previous quarters about the dual mandate that central banks have. So the central banks around the world are trying to balance achieving full employment in their countries, as well as price stability and not having too much inflation. So they're trying to use interest rates and other things as a monetary tool to achieve those two targets. And that's a difficult balance, especially when there's uncertainty as to what the tariffs will be and the final impact of those tariffs and how they would, flow through the economies in terms of both inflation and employment. So generally, North American central banks have been a little bit more data dependent lately, wanting to wait and see. Canada did cut earlier. The Fed has been on pause, but wanting to sort of see what's going to happen out of these various data points on the economy and tariffs. Europe has been more stimulative, seeing more rate cuts to date. Which has led a little bit of the growth that we've seen in European markets. So our feeling is that perhaps the Bank of Canada will pause again on July 30th, which is their next announcement. We had some decent CPI report, but it did show a little bit of an increase in the inflation rate in June. And there was also strong employment report, so not indicating a need for a big rate cut for that purpose. So the market still seems to be pricing in some small rate cuts later in the year, but perhaps not on July 30th. The U.S. Federal Reserve, as I'm sure people have been reading, it's been very topical, especially the past few days, but they've been on pause on rates, feeling, from Chairman Powell's point of view, that he really needs to see the data and understand where things are before acting. So they've held firm on that in spite of growing pressure from the administration to cut rates. And we'll talk in a minute about how much independence there is in the Federal Reserve Board. On the other hand, as I mentioned, the European Central Bank has been gradually lowering rates through the year, and that monetary stimulus, along with the fiscal stimulus they've had, has helped their markets. So I think the question in the US side that probably everybody's reading about on the next slide is just sort of how independent is the decision-making around rates in the US. So I thought it was interesting to just pause for a minute on who makes that decision. So monetary policy in the US is governed by the Federal Open Market Committee, the FOMC. You probably see that in the press a lot. The membership of that committee is made up of 12 voting members. 7 of those members are appointed governors. There's also the other 5, I guess, come from the banking sector. There's the president of the Federal Reserve Bank in New York and 4 rotating presidents from other regional Federal Reserve banks. So a consensus of those members is required for any change in the benchmark rate. So differently than some other federal central banks, it's not only the chairman that makes the decisions. It has to be a consensus of these 12 members. We were sitting with some U.S. Analysts and consultants yesterday, and they made the point that right now the membership of the committee is quite balanced. There are about 4 hawkish governors, 4 that are neutral and 4 that are more dovish. So you have some people that are keen to keep rates up for longer, some that are keen to see the rates come down, and some that are in the middle. Chairman Powell, who is in the neutral grouping of governors, has a term that officially ends in 2028. There's also Governor Kugler, who is in the sort of more hawkish camp, whose term is up early next year. So there could be some change in that makeup. As you will have seen, there's a lot of pressure from a number of fronts, but especially from the White House on Chairman Powell to have the committee move forward and lower rates. Chairman Powell wants to be very independent and look at data to make that decision. I think Jamie Dimon came out of JP Morgan the other day saying, don't sacrifice this independence. It's very important that the FOMC remains independent. I think President Trump said yesterday he's not likely to fire any chairman as long as there's no fraud. So the markets felt a little bit better that there was not an immediate change being proposed. But I think generally speaking, there is some independence here because there are 12 members and they do look at data to try and make the right decision. So I think we'll still see some pause for now and some look at that data before we see reductions, but we will eventually see some rate reductions ahead. The other question that's come up a lot is, as we looked at those returns, you could see that year to date, the US returns in Canadian dollars were only up 0.8%. Versus other markets internationally and in Canada that were a lot higher. That's very different than we've seen in prior years where the US market has been the strongest driving force. So there's been some discussion about, do we still see US exceptionalism in terms of market returns and expectations, or do we think that may be shifting? So there definitely, as I said, there was a change in that trend of US markets consistently outperforming year to date this year. Now, the reasons for that, part of it is valuations matter. So US equities are still more expensive. There's still some other markets you can buy into at better prices that would see some more upside. The US dollar levels also matter. So the US dollar being under pressure has impacted those returns when we look at them in our currency. But also, as I've alluded to a couple of times, there's more stimulus in some other areas of the world than there is in the US right now. So Europe has got higher fiscal spending, especially around defense. And they're also having earlier rate cuts. So there's more stimulus happening in those markets. There's more stimulus happening in China, et cetera. But on the other hand of all of that, there are still some very good, strong businesses in the US. So I don't think anybody's ready to say, let's abandon the US. I think what it means to us is that there are still some great businesses in the US. There's still some great investment you can make there around AI and other technology plays, as well as just very good, strong businesses. So we don't want to abandon that. But because of this changing landscape, we do want to focus on the benefits of geographic diversification in the portfolios. And that's been a positive thing for returns this year. So where do we go from here? I think with all of the things we've talked about, we have to remember that uncertainty and risk remain. So we continue to have that uncertain trade environment, that we don't know exactly where tariffs are going to land, and we don't know exactly what the impact will be once it flows through the economy. We still have geopolitical risks in a number of areas of the world that are worrisome. As we know, people highlighted their concerns at the beginning in the polling question. And we have markets that are pretty expensive, especially in the US. So we expect some greater volatility in the second half of the year. We also expect some slowing economic growth. If you look at some of the economic indicators, and if you think about the impact of tariffs, we think there'll be some slowing to the growth rate, but we don't necessarily think that will lead us into recession. We hope not. On the other hand, we're aware of the risks, we're aware of those slowing growth directions, but we do think there are some tailwinds in certain places. So we will eventually see rate cuts. I think they'll be smaller and slower than we hoped at one point in the year, but we will see that eventually. We do see some fiscal spending, and we continue to see, investment and secular trend improvement in AI and technology. So those are things that can really still drive positive returns. So finally, from there, where do we position portfolios? I think it's a little bit of wanting to balance the defensiveness, which comes from diversification and good quality stocks, with some selective offense. So with some of those companies that are positioned well in technology and in growth industries, we want to balance those two together in the portfolio. We also still feel that where liquidity is needed in the next little while in your portfolio, we'd like to maintain cash and short duration bonds for that protection. We definitely want to have diversification in many areas, so across regions and sectors and those factors that contribute to your portfolio. That diversification will help enhance resilience and reduce volatility, which we think will grow. And then again, we want to have a core equity exposure that's high quality to balance the risks, but we then want to also look at investment in some companies that are benefiting from AI. And those can be in different places. So that can be the AI tech companies, but it can also be which companies are good quality companies that are actually using AI to become stronger within their own markets. So it's a little bit of a balance, make sure we have cash and short-term bonds where we need it, make sure we have defensiveness in terms of diversified portfolios and good quality, but then look for some positions that are also going to grow. And that's sort of what we're seeing our managers do and what we're keeping an eye on. Thank you.
Thanks, Krista. I think that really helps set the stage. I'm going to turn things over to Frank Settino, who leads our Montreal investment team and chairs the Kerr's investment committee. He's going to dive into our portfolio strategy with a focus about alternative investments in today's environment. But he's going to start out with a polling question.
Good afternoon. So the second polling question is, what percentage of your net worth is held in alternative investments or assets? So when we define alternative investments, we refer to any assets that are not cash, bonds, or stocks. So alternative investments could be a second residence you might have that's south of the border that you use personally or you rent, or it could be gold bars, which were very popular in the 70s and have become back to become very popular purchase items for Costco shoppers, or it could be more common alternative investments in hedge funds or private equity strategies or real estate. So the different choices are A, 0%, B, 0 to 10%, C, 10 to 20%, or D, over 20%. So we'll wait for the responses, which will lead into our conversation about alternatives in obviously more detail. So we'll wait for the results from the polling questions.
Yeah, we're just gathering. People are still voting, so we'll give people another few not minutes, but a few seconds to vote, and then I'll turn it off. Get your votes in now. Already, I'm going to end the poll. I'm ending it, and I'll share the results for you, Frank.
There you go. Quite diverse. So I would say the overwhelming amount would be 0% at 29%, 26% have 0 to 10%, 16% have 0 to 20%, and a nice number of respondents have over 20% at 29%. So that is quite interesting in terms of results from that question. And I think today we really want to dive into the topic of alternative investments. As we've seen a rising trend within our industry to incorporate private investments into portfolios. I think at the forefront is BlackRock, the world's largest asset manager that they oversee over $10 trillion of assets, who has been acquiring, I think, specialty alternative managers in recent years, and last month announced that they were going to include private assets in retirement plans. We've seen a similar shift here in Canada. Regulators opened the market for liquid alternative funds in 2019, and by the end of last year, that liquid alt market in Canada had over $30 billion in assets in a variety of hedge funds, private credit, and real estate funds. So we'll be highlighting survey results that will show you the different allocations to alternative strategies from different segments of investors. We'll then touch on, I think, one of the key factors that we believe is causing investors to look at diversifying their portfolios away from the traditional balanced portfolio. And lastly, we'll highlight the 5 key characteristics that investors should be mindful of before making allocations to alternatives. So this is the first slide, and it provides some perspective on what portion different investors have allocated to alternative strategies. So starting from the left, institutional investors such as pension funds, endowments, and sovereign wealth funds have been at the forefront of investing in alternatives. So institutional investors are unique in that they obviously oversee large pools of capital. They typically have time horizons measured in decades, and they have the good fortune of having teams of investment professionals seeking opportunities across the globe. Therefore, they have the risk profile and the financial resources to invest in strategies that are frequently quite complex. So based on this survey, institutional investors have 78% of assets in alternatives. The second cohort are families and ultra high net worth families that have 19% allocated to alternatives. So we have the good fortune of working for families in this group. And in general, we've noted that allocations to alternatives have risen over the last couple of decades. The last group on the right, that's high net worth investors who have only 2% allocated to alternatives. From our perspective, that figure seems a little low. I think we would have probably estimated that would be higher. But nonetheless, it does underline that there is significant room for alternative allocations to grow for an important and a growing number of investors. The next slide provides a more granular look at the strategic allocation for US-focused family offices that we've captured from the latest report from UBS. Interesting that the allocation to alternatives is greater than 54% in this survey. In addition, both private equity and real estate are the dominant asset classes, with over 80% of the alternative sleeve being made by these two assets. The next slide really highlights that traditional asset allocation that has been at the core of many investment portfolios for many decades. So in this example, 40% is allocated to broad Canadian bonds, and 60% is in stocks, evenly divided between both Canadian and global equities. Now, the historical return profile for this portfolio has been very attractive. The 7.5% annualized return for this portfolio over the last decade has been a solid return, particularly when you consider the very modest returns that cash equivalents like GSEs have earned over this period of time. But if you look at the chart on the right that highlights the return attribution between fixed income and equities, you'll notice that the bulk of the returns have come from equities. And in fact, in that 2022 period, bonds were actually detractors for portfolios during that period. The following chart provides a more detailed overview of Canadian bond returns over the last 3.5 decades. As interest rates fell during this period, you'll notice that bond returns fell from 10% in the 1990s to only 4.5% in the past decade. Therefore, For an investor 3 decades ago that was seeking that 6 to 7% return, that objective was quite achievable when you consider that bond yields were in that 6 to 7% return, 7% range. Now, with yields closer to 4% today, that same investor needs that equity component to drive a greater share of the total return, or they need to increase the risk exposure and have more equities in their portfolio, or perhaps they fall the risk of falling short of their return objective. The next slide highlights another interesting aspect of the traditional portfolio is that, when you had 40% allocated to bonds and 60% highlighted to equities, you had negative correlation, which obviously has shifted drastically since 2020, when bond markets have become far more volatile, and the diversification benefits of holding bonds has diminished. This is one of the reasons why we believe investors have been exploring alternative strategies to identify investments that can help and achieve the return objective, but also with less influence from factors that are also influencing equity returns. We believe that if an investor's risk profile and the return objective aligns well with investing in alternatives, an allocation to alternatives should be evaluated as an option. Now we want to jump into the 5 characteristics investors should consider if they're considering alternative investments. So moving on to our first slide. So the first characteristic is that many alternatives require investors to have a long time horizon. So yes, this is a common feature for investing overall, but for many private investments, particularly for drawdown structures that are common for private equity and real estate, there is a predetermined investment period. So this is a hypothetical example of a private equity investment. So in this example, an investor makes a commitment to investing a set amount as a limited partner. So the general partner who is managing the strategy will call capital from the limited partner in years 1 to 4. That capital is fully invested in years 5 and 6. And then during the harvest period, the general partner usually sells investments and returns capital to the limited partner. It's very common that the investment period lasts a decade, and it's quite possible that there's extensions triggered, and investors could be in the harvest period for a couple more years. So why does this happen? Well, in certain situations during the harvest period, a general partner will see asset prices weaken, as we've seen most recently for private equity and real estate. That will cause them to defer selling assets at distress levels. Therefore, adding alternatives truly requires having a long time horizon and having the capacity and the confidence in a general partner managing the investments through different investment cycles. The second, and probably the characteristic that has the most opposing feature to traditional asset classes, is that alternatives offer lower liquidity. This graph attempts to capture the liquid nature of private investments in blue relative to traditional investments in red. Whether investing in low risk, low return assets like money market funds or in higher risk, higher return stocks, the liquidity feature has improved greatly for traditional assets over the last 3 decades. For example, if you own a stock or an equity fund, you can sell and have access to the cash proceeds the next day. That's simply not possible for alternatives. While alternative mutual funds have comparable liquidity features to traditional funds, they do have holding period requirements. Moving to the right, hedge funds usually have 60 to 90-day settlement periods, and many funds limit investors' ability to when and how much of investments can be redeemed. Moving further to the right, in the higher risk, higher return spectrum, whether it be private equity, credit, or real estate, here we have limited or no liquidity options. Though secondary markets exist and are viable liquidity options, it's quite common that the discounts investors receive relative to market valuations are quite steep, making the option not particularly attractive. Therefore, it's imperative that with any alternative investment made, and an investor should be able to tolerate not having a liquidity option at their disposal. Moving to our third characteristic is that alternatives typically offer investors with far less transparency. This table tries to convey this feature comparing traditional to alternative investments. A traditional investment provides investors with timely and full disclosure to information. So an example would be a mutual fund or an ETF that provides you with the fund holdings and the weights either on a daily or on a monthly basis, with additional disclosure on a quarterly basis. For alternatives, information is usually available only on a quarterly basis and at times could be opaque and not provide investors with much detail. In terms of price discovery, traditional assets have excellent transparency, with websites that list the price investors are interested in buying and selling a stock at during a trading session. For alternatives, it could be challenging to obtain how managers have assigned a value to an investment. Oftentimes, the methodologies are quite complex and come with very little detail. While there is regulatory oversight on both traditional and alternative investments, the requirements upheld by regulators such as the Securities and Exchange Commission are far more stringent for traditional investments. The standards strive to provide investors with timely, accurate, and reliable information. Lastly, the flow of information available to traditional investments is far greater than for private investments. For example, a public company will provide a shareholder with an invitation to participate in the annual general meeting, the ability to meet with executives at industry conferences, and the ability to potentially hear from executives on social media platforms. For private equity investors, that flow of information is simply not as accessible. Therefore, investors need a certain comfort level tied to having less information before and after making a private investment. The next characteristic should not be a surprise. So investors should expect to absorb a higher cost when owning alternatives. In most cases, these investments require a lot of complexity. It requires resources from a team of professionals with tax, legal, and financial expertise. Investors should expect to pay management fees and operating fees that are common for many traditional investments that are either based on committed capital to the investments or assets under management. Then there are two additional costs that I think are unique to alternatives. First, there's a performance fee. And this is an additional fee that's earned by the fund manager or the general partner that is received once they achieve a return threshold. The second cost that is often overlooked ties to the additional tax compliance required for an investor. An example is investing in retail properties in a foreign country and having to prepare tax documents on earned income and transactions to both Canadian and foreign authorities. Again, before adding to alternatives, understanding these associated costs should not be ignored, as investors' returns are earned after these costs. The final characteristics investors should be aware of before trading into alternatives is understanding the wide divergence in investment returns within the alternative asset classes. This chart is from JP Morgan, and I think it does a fine job in highlighting this very important feature. The chart details the range of investment returns within both public and private investments over the last decade. On the left, you have global large cap equities and global bonds. So global large cap equity managers have generated returns ranging from 7.2 to 8.9% over the last decade. So the difference between the best and the weakest global equity manager is only 1.7%. Therefore, if you consider an investor expecting a 8% return from this allocation, the worst outcome of 7.2% is indeed disappointing, but it only fell short by 1%. Now, the bars on the right highlight the return variances for alternative investments. What you'll note is that they have far greater ranges than that for global equities and bonds. For example, the returns for a global private equity range from 1.5% to 21.5% 8.4%. Therefore, there's almost a 20% difference between the best and the worst private equity manager. So that same investor who might be targeting a 10% return from a private equity allocation, in the worst case, that 1.5% would be a pretty devastating outcome and fall well short of their expectations. Therefore, for investors, that great divergence in the potential returns for alternatives should alert them to the importance of the due diligence and the selection process, as the range of returns could be fairly material. Now, this is the final slide, and I think it captures the opportunity of adding alternatives to a traditional portfolio. The chart highlights the return and the volatility of two distinct portfolios over the last 26 years. We have a 40-60 equity portfolio that generated a 7.3% annual return with 9.9% volatility. And we have a second portfolio that has 50% in equities, 30% in bonds, and 20% in alternatives. Now, this portfolio generated a higher return of 8.1% with lower volatility at 9.1%. So this is what investors should be striving for. So generating fairly competitive returns with less volatility in the stream of those returns. We think and we expect alternatives to become a far larger part of conversations that we're going to have with investors. We think that investors hopefully use some of the features that we've highlighted in our conversation today to help them make fairly educated decisions whether or not they should be adding alternatives to their portfolios. That's all. So that summarizes my thoughts, and I'll pass it back to Kathleen for questions.
Thanks, Krista and Frank. That was excellent. A really great overview. I think there was a lot to take in, especially given the pace of change that's been happening. We've got a few questions that have come in, and I've got a few of my own to help draw some of the insights from our discussion that you talked on. So I'm going to turn off the share screen here. Wait a second here. I'll just stop sharing. And I'll jump into the questions that we have. I'm going to start it off with this one. And maybe it's better to take it from you, Krista, but I'll ask Frank to jump in as well. Markets bounced back, quickly, you were talking about after the April tariff shock. Based on the conversations you've been having with our investment managers, are they leaning into that rebound? Are they staying caution given the risks? So what is your experience with them?
Yeah, I think we've stayed invested as part of the thing. We didn't abandon that and then try to jump back on as markets recovered. I think with a lot of the managers, we saw them take some risk off at the end of last year when they were concerned, and then put back on some positions in the first half of the year as they thought that things were firming up, and that made sense. So there was a little bit more investment that way. But I think generally people stayed invested, so participated in the upside that way as opposed to chasing it. But there has been some investment after the risk was taken off a bit at the end of last year. And Frank, what are you thinking from our managers?
Yeah, we obviously saw, particularly from our equity managers, they took advantage of some of the volatility that we saw in April and added to positions. So that presented them with an opportunity. But since then, I would say status quo. I think you captured a lot of the comments that relate to how the managers have managed through this period of time.
Thanks.
All right. You talked a bit about fixed income, Frank, and Krista also mentioned that the Bank of Canada may pause again. The Fed's under pressure. How are our fixed income managers positioned? And are they still staying short? Are they extending their duration? What are they doing?
Yeah, I think for our fixed income managers, they've been fairly cautious. They've been cautious for a little while, both in terms of duration and credit quality. They've been, I think, more diligent in making sure to be wary of the inflationary risks. So I would say there hasn't been a great deal of change. They remain, I would say, cautiously positioned on the short end of in terms of short-term bonds and they have taken, I would say, relative to a year ago, they probably have less credit risk in their portfolios than they had then. So I would say our bond managers have been protective of capital during this period of time.
Okay. Anything to add, Krista?
No, I think that I agree with that. Yeah.
You talked a bit about the US, and so, a question that came in is when within an equity portfolio, what should an investor do? Should they be trimming or exiting any US exposure in favor of Canada or EFI? What is your general thoughts on that positioning?
I think it depends on where they start from. It was interesting. I was down in the US at a family office conference for the past few days, and there's a very high percentage of investment assets that are in US equities for
Right.
US families. So for those families, they were talking about you should lighten up a bit on your US exposure and have some more international exposure. I think in our cases, we've often been diversified. You have some clients that come in with quite a bit of Canadian stocks already, having the banks and some of the utilities in those companies that they're used to because they've had them for currency reasons, and then having some balance of US and international. But definitely, if you see a portfolio that's too skewed to one geography, we think that diversification is the important thing because there are different, as we mentioned, different stimuluses coming up in different areas, and different valuation risks in different areas too. So if someone was very heavy US, you might lighten up a little bit. Otherwise, just make sure you've got that diverse representation across geographies in the portfolio.
Interesting. And if you, and from your discussion with our managers, are we seeing any tweaking with their positioning or their thoughts when we're working with some of them, given what's been going on with the US this year?
Yeah, I don't know, Frank, I was just looking at some of the balance funds and seeing it. It looks like overall there hasn't been a major shift in that, but we did, maybe have a little bit from about a year ago, a little bit of a change in how much US versus international and Canada, but what do you think?
Yeah, I think our value managers have been probably far more cautious on the US for some time. I would say probably starting at the tail end of last year and maybe
Right.
early 2025. They've been evaluation is the concern. I think the evaluation is the key concern.
Right.
It has less to do with policy. It has more to do with valuation, and they've been cautious for a while. And I don't think they've changed their tone, despite the fact that we had some volatility in the first half of the year.
Right, right. Interesting. And one of the questions that came in, and I don't know if it fits in with alternatives or whatnot, and we haven't really touched on it, but if we have any thoughts on how does Bitcoin play within our clients and their portfolios?
Yeah, it was funny. The speakers, one of the speaker groups yesterday, they were wonderful speakers and they were talking about the outlook for the market, and they had sort of a rapid fire at the end, interest rates by the end of the year will they be higher, lower, the same, and they concluded lower a little bit. By the end of the year, will the market be or the economy be in recession, yes or no? And they said no, which was good. And through those rapid fire questions, someone said Bitcoin and they said pass. That was they didn't want to provide an opinion. I think it's still a very speculative asset, is the bottom line. So it's not a core part of our portfolios for that reason. I think it will continue to be volatile. There's certainly been, run up at certain times, but it's hard to predict where it will be because it doesn't trade just on fundamentals. It trades on, emotions sometimes too. So yeah, I don't know if, it's not a core part of what we're using for that reason, for the highly speculative nature, but.
Sure.
Frank, any other thoughts?
Well, I think the notable point is that there's been almost 180-degree shift in terms of policy from the Biden administration to the Trump administration. There's far more support for cryptocurrency, stable coins. So I think that's notable. We've obviously seen a strong shift in the price of Bitcoin and other cryptocurrencies. So that's notable. So I agree on the volatility. I agree but there seems to be a greater acceptance of this. So what implications does that have? I don't have a strong opinion on that, and I would concur with Krista that it remains a very volatile asset at this point.
I think it's still hard to know what the regulatory environment is for it. So how do people know that what they're buying is what they want to have and that it will be regulated, et cetera? So I think while there's that growing support, maybe there will be some additional regulation to match it. Certainly something you have to watch because there, as you say, there's more acceptance of it as a future element in the economy. But
Yeah, no, definitely. You hear a lot more about it.
Mm.
So you talked a little bit about investor sentiment has improved. But are you finding that our managers that we're working with are equally optimistic, or are they still flagging the risks that we should be watching?
Yeah, I mean, it seems to me that the managers are a little bit cautiously
Right.
optimistic, maybe. I think they see again that split of factors that are supportive, but also the risks. And so it's a bit of a balanced outlook, I think.
Right. And any thoughts from your side, Frank, from your
I
discussions?
would say relative to 12 months ago, they're more cautious than they were 12 months ago.
Oh, okay. Okay. Interesting. Interesting. Had a question come in here, and I think maybe I'll direct it to you, Frank, since you were talking about alternatives. They were just asking for high net worth clients. What percentage would you suggest in alternative investments? You know, I guess realizing the illiquidity and higher risks and returns with the long-term investment horizon. What's your thoughts on that?
Well, it depends, right? I mean,
Right. Of
it has
course.
to kind of fit, like I say, all the factors that we spoke about during the presentation. I mean, how what is liquidity for the client? What's their time horizon? Those are critical factors, right? And if obviously there is the ability, they've got long time horizon, they have the ability to kind of have no liquidity within their portfolio, then I would, I suggest that, having an allocation makes sense, and something in that 5 to 10% range, I think is a starting point. But obviously, like I said, it's very dependent on the client. It's unique to the client, unlike, I would say, traditional assets. I think traditional assets, there's I think there's more consistency, but for alternative assets, it's really almost customized to the profile of the investor.
Well, that makes sense. Now we're
Yeah,
at
I
1
think
o'clock.
Oh, sorry, I
Sorry,
just
Krista.
quickly add, yeah, I think we sort of usually look at up 0 to 30%, with a number of families,
Right.
and above that you get into maybe too much illiquidity. And actually, interestingly, out of the families that were at the session yesterday, they had sort of migrated from 10% up to 20%. So,
Oh, interesting.
not taking, certainly you see the big pension funds having greater amounts,
Right.
but in and around that range, I think, is what we see with families where there is the reason, the ability to have some.
Right, the liquidity. Oh,
Mhm.
interesting. Okay, so we're going to wrap it up. I'll leave you both with your final thoughts as we say goodbye to everybody who's attended here today. Any last closing?
You want to go first, Frank? I tend to take your comments. If you want to go first.
Well, no, but I think we've kind of highlighted obviously we're in obviously a more risk. Risk is back on the table. Everybody was avoiding risk now. I think investors should be mindful that there are still risks, although the markets are very buoyant. Be conscious of that things could shift. So it's important to maintain view of your long-term objectives and not try to time the markets. I think that was my message at our last webinar. I want to kind of go back to that comment, which I think remains something I would like to highlight to investors today.
Right.
Yeah, and I think just, I know we don't want to go too far over, but, because the fundamentals are still somewhat supportive, I think staying invested makes sense. But I think having that diversification, some defensiveness built in, all of that to try and manage your comfort level with risk, and being really clear on if you need to have some more liquidity to support your spending so that you're not going to be selling at the wrong time. All of those things should be looked at to manage through what we expect will be a bit more volatility going forward.
Right. Well, that's great information. Thanks so much, Krista and Frank, and for everybody who joined us today. Thank you. I hope this was helpful. And as always, if you have any questions or want to speak to anyone, feel free to reach out to our team. And I will be following up with a recording of the session that is for you to rewatch or to share with anybody who may be interested. So thanks, everybody, and we'll say goodbye till next time.
Thank you.
Bye-bye.
Right.
Bye-bye.